This is a Tesla worth £42,500, but hundreds of crafty business people in the UK are driving it around for 5 years at the total cost of just £15,515. In this video, I'm going to show you how you can use strategies like this and several others to save in total £61,923. Most people don't have any idea about these 8 crazy tax saving techniques. And I think I'm pretty nifty around finances. I mean, for heaven's sake, look at the name of this channel. But I had to talk to 2 accountants to drill into these hidden techniques that I'm going to share with you today. Before we dive in, remember, as always, this is not financial advice, it's not tax advice. This is journalism and education, and we'd like to think entertainment. Make sure if you're in any doubt that you talk to a professional advisor. Right, folks, we're going to start from the easiest tips and build our way up to the most mind-blowingest ones. So make sure you stick around till the end. The first tip is to switch from being a sole trader to a private limited company, because you see, companies are taxed at a much lower rate on average than individuals. And with a company, you have a much better chance of being able to borrow, and you have a wider range of tax saving strategies that you can use as your profits start mounting up. Crucial thing is, if you are a small business and don't actually have that much intention of growing much further, then it sometimes does make sense to stay as a sole trader rather than take on the rigmarole of a limited company. Now, most of the tax strategies will be focusing around extracting out that money. However, many people miss the really obvious thing that you can do, which is rather than extract out the money from your company, you can just leave it in the company and invest it from there. Because you see, look, if you have £100,000, you can either extract it and pay a dividend tax of 32.5%, or you can leave it there and invest it and worry about the extraction later. Because often, tax rules change, and sometimes you get some really great tax rules which allow for you to extract out all of that money really quickly, which if you hadn't waited for that tax rule to come along, you would have no chance at that. And if nothing changes, then you're no worse off anyway. Right, imagine the tea in this cup is the money that is sat in your company. There are 2 ways the HMRC can get at this tea. The first is HMRC is allowed to take 1 sip every year on the profits that you make. So this is the profits. The second way that HMRC can tax your money is if you take it out of the company and it goes into your personal pocket, they will tax you on your personal income and absorb that up. So what makes sense? To leave it in the company, because that is often where it is safest. Look, I know we literally talked about not extracting, but sometimes you kind of have to extract because you need money to survive on. So here's how to do it effectively. We talked to some expert accountants to get their views on the best strategies out there right now. Hailing from Bolton in the United Kingdom, weighing 12 stones, the accountant assassin, the man who caused 1,000 women's hearts to break when he married, the Bolton bulldozer, the accountant that HMRC hates, in a good way, Dominic Ball.
So paying a basic salary through the payroll is generally a sensible option for most business owners, particularly where their main source of income is their limited company. One of the key advantages to business owners who are married is that where their spouse is also involved in the business, whether that's performing some form of admin role or whether they're also a director of the business, means that they can also be paid a salary through the company as well. That means you can then both claim $9,880 in a salary through the limited company. You should be able to get a tax deduction on both of those amounts, and you both won't pay any income tax or national insurance on that amount.
So what he's saying is that when you have to extract, you should use yours and your wife's personal allowances and dividend allowance every year so that you can pay the maximum amount out without paying any tax on it. Ladies and gentlemen, this is where I compete with Zoella in talking about personal finance. I am at heart a hopeless romantic.
I get a tuna sandwich, it's pretty good.
I didn't like that, it was too... Yeah, it wasn't
too dry.
Yeah, it wasn't. It was too dry and it wasn't very good either.
Yeah.
But the other stuff is all right. I've got a great idea, Mohammed, for your Muzmatch.
All right.
Are you ready for this?
Yeah.
This is going to get you a wife really, really quickly.
Let's hear it.
What you do is in the description, you explain that you want tax benefits that come with a wife, and you're going to make her the director of your holdco.
Okay.
Right, let's go through it step by step. The first step is make sure you have payroll set up and make sure that you are taking an income out of your company as an employee of that company. So that's the first route of tax-free income. Make sure that this salary is set below the personal allowance limit and also below the limit where you have to pay national insurance. That way, you get no tax paid when you actually get the money as income, and you can deduct the amount from your company's profits as well and pay no corporation tax on it as well. All of this will help you get your first £10,000 or so out of your company tax-free. We'll talk about your spouse in just a second. After that initial step, the next play is to use your dividend allowance in a strategic way. If you're married, you should split your shareholding. This is where your spouse comes in really useful. And don't worry if you're thinking about divorce, then if you're legally married in the UK, the divorce courts will typically split your company in half anyway. So it's not like you're legally disadvantaging yourself. Right, let's imagine you've got a guy and his spouse happens to not be working. She's not using her personal allowance, she's not using a dividend allowance, she's not really using anything. Now, if he's got a holding company set up, and a holding company is a company that owns his company, then what he can do is he can set up his wife as a director of that company, heady position of responsibility, make sure that she's doing some work so that it's actually legit, and then you can pay her an income, and then that money can go to her and it can be used for the family expenses. So what's happening now is the guy is using his personal allowance for the income, his wife is using her personal allowance for the income, they're both using their dividend allowance of £2,000 each, which is also tax-free, and the remaining amount, which is around £35,000 or so, is going to be taxed, but it's going to be taxed at 7.5% dividend tax because, importantly, they are both under that 50,000 threshold, where if you go above that threshold, you go into the higher rate tax band, but they've kept under that. Now, alternatively, if this fella had decided, I'm going to take this £100,000 that I have and extract it out using dividend tax, that would have cost him £27,787.50. Instead, if he does it this way, with his spouse involved, he is going to pay a grand total of £6,174. So in effect, by doing this one simple thing, he has cut his tax bill by 1/5. So for you guys who are in your late 20s and you're telling your parents, oh, I'm not going to get married because I want to work hard and make some money, your spouse can actually help you save a lot of tax. So that argument doesn't apply anymore. I'm glad we were able to get through those numbers together. It was tough, it made me feel dizzy, but we're here now and we're making money. The next tip is to rent your property to your business.
What you can do if you are using a room in your house for business is to charge what's called a use of home as office charge. Now this is an amount which you can work out, depends on how much of the house that you use, and you can take a proportion of your overall expenses.
If you personally own the premises, then make sure that you're paying out that rent, because when you pay the rent, that is an expense for the company, and any expense reduces your profits, and that means that you don't have to pay corporation tax on it. Also, because you're making it come out as a rent into your pocket now as an employee, you don't have to pay any national insurance on it that you would if it came out as an income. So you're saving tax on multiple angles. You will have to pay 20% income tax on this, but your company has saved itself from 19% corporation tax. So the net result is that you pay 1% tax on this amount of income that you're taking out as rent. So if you do have premises that you use, make sure that you avail of this tip. And remember, make sure when you do this that you don't end up accidentally classifying your home as a commercial property and then that hits your council tax. And apparently, I'm told that the way to do this is to not specify a particular area of your house that you call your office. Rather, you're just working at home in different rooms. Let's assume that you rent out your property to the company for £1,000 a month. With corporation tax and national insurance tax savings, that is £2,661. Right guys, I'm gonna say a really boring word. I want you to just sit there and take it like you're going to a dentist. I'm gonna say the P word, pension. Make sure that you are making a pension contribution from your company. See, it wasn't too bad, was it?
So a SIPP is a self-invested personal pension plan, which is effectively a personal pension wrapper, which allows you to put funds into this wrapper and make investments for your future retirement and future earnings.
If your company makes a pension contribution to an employee, then that all becomes an expense and is tax deductible. You can make a total contribution of up to £40,000. That adds up to a corporation tax saving for the company of £7,600 annually. This money can then be sitting in a SIPP and can be invested. And by a SIPP, I don't mean what I just did, I mean a self-invested personal pension. So let's break that down. This is the maths behind a SIPP. So let's say you have £100,000, one of these matchsticks is worth £10,000. In total, there are 100,000 of them. If you don't take a pension out, all of it is exposed to tax. However, if you do take a pension out, then you can take 4 of these away and only this much is exposed to tax. So in effect, if you don't take a pension, you're exposing your entire income to the flames and burning and pain of HMRC and tax. However, if you do take a pension, then you've actually protected around 40% of that earning. And folks, another way to put it is this is literally just free money. So if you put in 40,000, the government is going to top you up with another £10,000. If you don't contribute that 40,000, the government is not going to give you that 10,000 top up. It's as simple as that. The other thing is pensions are only taxed when you extract them and they grow without any of that capital gains tax as well. So it's a great safe haven. Then at retirement, you can take 25% of your entire pot tax-free and then the rest of it you can leave in and extract out in a tax efficient way every single year. If you're looking for a SIPP provider, particularly those who do ethical or Sharia compliant pots, then PensionBee is an option to consider. They seem to be doing well with customers. They've had thousands of reviews and they're rated 4.6 on Trustpilot at the moment. PensionBee allow you to aggregate up all of your different pensions that you might have knocking around from when you were employed in different companies and put them all into one place. And for Muslims, particularly, it's important to make sure it's in a halal pot, and PensionBee luckily does have a halal pot for you to park your money in. So the pros of this option is that PensionBee is the low cost option because it's pretty much automated. You don't get any personalized advice around your pension and it's pretty quick and it's seamless because it's technology. The cons are that if you have a larger estate or a larger pension and you want to invest in more exotic things like property and unlisted shares and various other things, that kind of SIPP is possible, but PensionBee are not the people to provide that for you. If you'd like to find out more about these guys or other SIPP providers out there, we've done a detailed analysis of this and the article link is below. Now, people with parents and kids, you need to pay attention to this. There is a tax strategy that allows you to pay for your kids' fees and extracurricular activities and all of the other expensive stuff associated with them in a tax efficient way. Right, let's say we have Dawood and Dawood Senior. Now, Dawood Senior can actually hold money that is given to him on trust for his grandchildren, and he can pay out that money to his grandchildren and they can effectively then use their personal allowance, i.e. their income allowance, and their dividend allowance, giving them £14,570 every single year that they can use without any tax paid on it for their school fees and various other things. What a great way that is to send your kids to private school. So let's do the maths on that. Assume you have 2 kids. The saving for each of these kids, given the taxes you've saved, will be $3,412, and with 2 kids that will be $6,824. This kind of strategy is perfect for people who work in the same company as their parent, i.e. the grandfather or the grandmother of your children, and you can use this really effectively in that case. Yep, you're hearing me right, folks. I'm telling you to get an electric car if you want to make a tax saving on your company car. Electric cars are not only pleasing on the eye, good for the environment, they're also great to run through the business as an expense. You see, the government has introduced this new policy where electric cars with zero emissions are given a preferential tax treatment. That means that if you buy an electric car, let's say the Tesla Model 3 for $42,500, then you can use that as an expense for the entire sum in the first year, saving you corporation tax and national insurance tax of somewhere in the region of £8,000. This is all about the benefit in kind legislation, which basically means that if you give a gift or some kind of benefit to your employees, then they will potentially have to pay tax on it. However, because of this preferential tax treatment, an electric car only gets a benefit in kind percentage of 2%. That means that not only do you not have to pay tax on it as a company, when you give it to your employee, they only have to pay tax on it for 2% of the value of that car. So in this circumstance where I've bought a Tesla, 2% of the value of it will be £850, and therefore I would have to pay a tax annually on it of just £170. But there's even more that's beneficial. You can put your insurance and maintenance costs for the Tesla through the company as well as an expense, again saving you corporation tax on each penny and pound of that expense. Unfortunately, it's not all just milk and honey. There is a slight downside as well. So after 5 years, if you sell that Tesla, let's say for half price, about £21,000, that is money that is going to go back into the company's account, and you will have to then pay corporation tax on it. But of course, it will be a much cheaper amount because the car has depreciated in value. So this isn't a permanent relief, and it does involve you buying a relatively expensive electric car. But if that is something that you want to do anyway, you can save around £10,000 in tax by doing so. And when we model the 5-year holding period for a Tesla, you can actually end up doing it and selling it for, let's say, £21,000 at the end for a total cost of around £15,515, which amount compares really favorably if you were to lease the same car. It's approximately half the price of leasing the same car. Phew. So there you have it, folks. That's how you can save £61,923 in a single tax year with some very fast and entirely legal moves. With many thanks to the accountants that we talked to for this video. Links to their websites are in the description below. So folks, I have literally just helped you save £61,923. My request to you is to click that subscribe button for free. Do it now.